Hello, Forex traders. This is FX with Q. Today is Monday, June 18th. The first part of this video, I'm going to be talking about where markets are now. So starting with the U.S. equities, the S&P 500 stayed in a tight range. In fact, the weekly candle is a small, slightly asymmetrical doji. Friday, we hit weekly lows on the announcement of Trump's $50 billion Chinese import tariffs and the subsequent Chinese response of a $50 billion tariff package of their own. Looking at the VIX, we had a small vol spike on Wednesday during the FOMC meeting minutes, and then a spike on Friday's open as markets digested the news of the U.S. tariffs. Overall consolidation, we saw a return as the vol sellers have really faded. Looking at commodities, they were hit hard by the trade news on Friday. There was a gap down on Friday morning and subsequent losses, putting the index nearly 3.5% lower from the week's open. Looking at oil futures, they were initially quite bullish early in the week. Crude's drawdown from the week's highs was nearly 4.5%. So whatever macro forces at work on the rest of the commodities affected crude even more dramatically. Speaking of commodities, gold had a dismal Friday as well, falling 1.75% from its open. Gold is an interesting case because when we measure it priced in dollars, it can bounce around in response to dollar strength or weakness. But on Friday, this didn't appear to be the case, because going back to the dollar index, we can see that the dollar did not have a banner day on Friday. So there were most likely other factors at play, which I'm going to discuss later on in this video. Looking at the dollar's week, we can see a large reaction to the ECB's rate decision and statement on Thursday. Much of this, when we look at our aggregate currency indexes, was due to euro weakness that day, as opposed to across-the-board dollar strength. Remember that the dollar index maintained by ICE is trade-weighted, so the euro is going to have an outsized effect on this index. And then finally, looking at emerging markets, EEM continued to move to the downside after last week's turnaround off of the descending trendline resistance. There are several macro themes at work driving disinvestment in emerging markets. Chief among those are global quantitative tightening and the trade wars, both of which I'm going to touch on later. So back to gold for a moment, because I find this to be a pretty interesting case, and this move on Friday is a little puzzling. If you look at the role of gold in investing, it can be used as both a store of value to protect against rapid inflation and as a type of insurance against large, dramatic downturns in the business cycle. If we step aside for a moment and take a historical case, we can look at the 1970s. The economics of the 1970s are often characterized as a period of stagflation, where there was high inflation but inconsistent and low growth. Investors in the 1970s respond to the conditions of stagflation by rebalancing their portfolios with gold, as the equity markets struggled. Of course, there are massive differences in fiscal policy, global geopolitics, and even the forex markets themselves were markedly different in character, with the repeal of the Bretton Woods being a recent phenomenon in the 1970s. So as we can see, the 1971 repeal of Bretton Woods marked another interesting milestone for the U.S. economy. Looking at merchandise, this net merchandise balance here, because it's the beginning of our role as net merchandise importers as well. But that's not the only important trend. The way Americans thought of themselves in economic terms, our national identity, was changing. We were starting to re-examine ourselves as a manufacturing powerhouse and champions of gritty industrial progress, and instead our purchasing power as consumers and the rise of the service financial services was redefining who our nation's economic leaders were. The above caption on the merchandise trade balance chart that reads low tariff rates is especially relevant today, as the current administration is starting to take policy actions in the opposite direction, in the direction of normalizing this trade balance. And looking back at the composition of the economy, this too fits the current administration's narrative as something that policy is looking to change, to push back. It is natural for politicians to put the hard hat on and promise to revitalize the manufacturing sector, but this time appears to be different, as we see the beginning of both domestic and foreign policy changes moving towards developmental capitalism, using economic protectionism as a primary tool. Finally, we will round out our historical analysis of gold to look at one more factor: monetary policy. Shifting our focus to the U.S. Fed funds rate, we can see that in particular, long drawn-out periods of hawkish policy from the Fed promoted gold to rise along with the rate. So, at least in our window here of the 1970s, there were periods of time when gold was positively correlated with U.S. interest rates, and that's when the Fed was looking to normalize the rates, tighten, and be hawkish. Obviously, there are many factors at work in determining gold prices over the long term, but what looks to stay the same is gold's use as a store of value in uncertain times. So for the next part of my video, I'd like to talk about the significant monetary policy developments last week. I'd like to move on to discussing monetary policy developments because they're going to be important moving forward, just in being an underlying theme that we need to evaluate where we are presently and pay attention to moving forward. So we had three economic events tied to central banks. We have the FOMC statement and press conference on Wednesday, the ECB financing rate announcement and press conference on Thursday, and finally the Bank of Japan had a press conference and monetary policy statement. So here's a curve which allows us to compare the monetary policy standing of the central banks of the majors, with China included as well. And this curve is incredibly insightful and a valuable tool for visually assessing the policy standing from dovish to hawkish of each central bank. The strategist who developed this chart is John Kicklighter of DailyFX, and I will put a link to his channel and Twitter in the description below. What I love about this chart is that it doesn't just represent the policy markers on a linear continuum in the X direction. That itself would be fairly useful, but this chart goes one step further, and looking at the y-axis, it also indicates the magnitude of the impact of a policy shift should have on the currency markets. So for example, if you look at a move up or down where the slope is steepest, that policy trajectory is likely to have the largest market impact. And that makes sense from a theoretical perspective because you have the law of diminishing returns, and if you look at a marginal cost curve, you're going to see there's going to be a bit of a an initiation, kind of a startup cost, if you will. So looking at this curve positionally and taking into consideration the hawkish standing of the Fed, then that kind of gives us a starting place for the lead up to Wednesday's FOMC statement. So the Fed was expected to maintain their hawkish trajectory and even shift to be slightly more hawkish. Largely, I believe that these expectations were met. They did hike, and there were some small changes, such as the wording of their statement, that indicate a slightly more hawkish bearing. So first, they upgraded their outlook for GDP and inflation slightly. And secondly, they increased their plan from one more rate hike to two more rate hikes in 2018. They're very optimistic. As this was in line with most expectations, it wasn't too much of a surprise. The markets didn't especially respond. So the Fed, doesn't want to be a surprise. To be a surprise would be the opposite of what they would consider to be a winning move. Their plan, really the game that they must play, is to keep their tightening and to keep their hiking policy changes kind of as part of the background noise, so that there isn't enough surprise to make a lurching recoil from any kind of decision that they put across the wires. So now moving on to discussing the ECB with Draghi's press conference on Thursday. They're in a more precarious position on the curve. It was widely expected that they should be following the Fed and be tightening their balance sheet and be moving on to a hawkish phase of their own with regard to their interest rate. Many commentators after Draghi's press conference praised his ability to coolly stay in the middle ground, because on the one hand, they stayed firm on the monetary normalization aspect. I mean, they even unveiled new details about reducing their balance sheet and tightening and sticking to that negative slope. However, they made an assertion regarding interest rates that was to markets, and this was a surprise in the dovish direction. And that's when they said that they did not plan to move rates from zero at least until the end of the summer of 2019. So 12 more months of zero interest rate policy from the ECB. And so we did see a reaction in the euro. We saw a substantial move to the downside, coming in as one of the worst days for the euro since the day after the Brexit referendum in June of 2016. And then finally, we can look at the Bank of Japan, and they're wedged in the dovish upper left-hand corner of this chart. Their status quo was anticipated, and on Friday they did not disappoint. They have the most aggressively dovish policy of the institutions on this chart, and keeping things monetarily easy for an extended period of time can quickly drive inflation. The measure is well below the critical value of 2%. So it doesn't appear that the Bank of Japan is going to make a hawkish turn anytime soon. So that's going to be it for my video tonight, today. Now Monday is looking to be a fairly quiet day in markets. There aren't too many major fundamental events scheduled to happen, and of course we have the World Cup as a distraction. So I'm gonna wish you guys a good solid week of trading. I may release a video in the middle of next week that's a little bit more anticipatory, a little bit more forward looking. So be on the lookout for that. And of course, I'll be updating you guys on Twitter on how some of the trades, my own market watching, how that's going. All right, thanks.